Public is the investing social network. And so we think the main reason people haven't historically invested in the markets, more than anything else, is a lack of financial literacy, which results in a lot of people just feeling intimidated by the stock market. And so to solve that problem, 15 months ago, we launched public.com based on sort of two key technologies that didn't really exist at the time. The first one being fractional shares, so the ability to buy any stock for any amount of money in real time. And then to your point, a true social network built within a stock brokerage where people can learn from other investors. They can build their financial literacy in a way that's more engaging and therefore more effective. And doing so inside the brokerage environment also lets us build a more sort of quote unquote safe network where we can have different guardrails. So our no day trading policy is one of those, but we also have launched features like safety labels that help indicate sort of to users what stocks might be riskier than others, which we found very helpful, certainly during situations like when Hertz kind of went bankrupt and still got traded up quite heavily.
Interesting. And for people who are wondering how you make money, it looks like a little bit of kind of the Robinhood pay for order flow type thing, but also you guys are involved in some short selling, lend out shares and that sort of thing. You're exploring a subscription model of uninvested cash balances. So there's a number of different ways that you can monetize this. I guess my question, though, is how do you ultimately compete with Robinhood? Like, do you think there's enough room in the marketplace for a number of these different platforms to exist or not?
Yeah, certainly. So on the revenue piece, I think one interesting thing about being an investing social network is that we have the opportunity to generate revenue from a diverse set of sources over time. And so it will not only be the brokerage revenue streams that everybody else is engaged in necessarily. In terms of the market, I mean, what we've really seen is that for new investors that are completely new to the market, the tools and features that they require are really very different than that offered by many other players in the market. So on Public, 90% of our investors make their first self-directed trade on Public. And I think if you look at what a new investor really requires, it's not necessarily all the bells and whistles and the very advanced features that many platforms have, be it margin or options trading or things of that nature, but really more a community that can actually help you grow your own financial literacy, that can present a sort of diverse set of thoughts around different companies, how to evaluate them, and help you understand solid investing habits and what it really means to build out an investing strategy based on a diversified portfolio and things of that nature.
Hey, Yannick, it's Kate. Good to see you. You mentioned when you guys banned Hertz, that was a bankrupt stock that got a lot of retail attention. There are some critics of that decision. I talked to the head of another trading platform who said that they won't do that. They'll take down some sort of content, but they're not going to ban what people can trade. How do you draw the line on which stocks to ban, what content to take down, and is there any risk of sort of over-regulating?
Yeah, I think it goes back to who's your audience and who are you really building for. So again, on Public, 90% of investors are new investors. And so with that, we feel a much bigger responsibility to ensure that people sort of know what they're getting themselves into. And so in the Hertz situation, it was a relatively unprecedented situation of the time, obviously, where you really had sort of a company that was being traded up, I think, 600-700%. I think in the few days after, immediately after actually filing for their bankruptcy. And I think our decision to stop, to halt the buying of Hertz shares was critical a lot, kind of generally throughout the industry, but certainly within kind of our user base, because the reality is that everyone doesn't always know exactly what's going on with all these different companies. And so the safety labels feature there really helped a lot of people just have a better understanding of what's happening with that company. And again, the way that works inside the flywheel of the social networks is you see sort of indicators of what's happening. You can then go to the community, you can actually get more background and then really just make a more informed decision. And I think that's something that we can all agree is just a massively net positive if we can actually have more informed investors overall.
Shepard Smith here. Thanks for watching CNBC on YouTube.